All right, thanks for joining for this video. Over the past couple of months, there's been really a lot of uncertainty going around as a result of COVID-19, and we've seen how the ramifications of that are broadly sweeping throughout the world and having a very significant impact in many different ways. And as a result of that, one of those impacts, name a few, is the impact on the financial sector, mainly to deal with what's going on in the stock market. And the question arises is whether or not stocks are truly worth it as investments. As we've seen the stock market take quite a big hit, and from its February high, dropped 10% rather quickly, losing $3.6 trillion in market value, which is, of course, connected to what people have saved for retirement and all other sorts of things. Are stocks really worth it? So in this video, we're going to be unpacking that, and that's a very easy question to ask. But it's a very difficult one to answer because anyone who's been involved in stocks or make decisions regarding investing knows that there are a lot of variables. And so we're going to try to address some of those variables and give you a better understanding of really if stocks are truly worth it from a general standpoint. Now, one thing I want to mention is we're not going to get into the fundamental analysis, like if stock A is preferred over stock B, for example, whatever that is. We're looking broadly at whether stocks in general represent safe and decent investments relative to other types of securities, whether it be bonds or just holding your money in cash or stuffing it under your mattress, which is certainly a viable option. So as we look at stocks, one of the things that we have to address very quickly is kind of some of the elements related to risk. So there's this dynamic in investing, which is risk versus return. So the risk of something is obviously the uncertainty or the potential for loss is kind of the risk element. And there are different types of risk, but usually when we're talking about risk, from a financial standpoint, we're dealing with the risk of us losing our money. Now, of course, there are different sorts of things like opportunity costs and other things related to our decisions. But from a financial standpoint, our risk is losing money. Right. The return is going to be the financial gain, right? So what's the reward? Now, what we'll find in terms of investing is that there's a relationship between the risk and the return. Let's see. Let's display it graphically. If on this axis here is the return, and so moving towards your right, return is increasing. And on this axis, your y-axis, this is the risk. And so this is where risk is increasing. As the risk increases, so does the demanded return. And intuitively, this should make a lot of sense, right? Because if your potential for loss is greater, you want to be compensated for that. Assuming that it doesn't happen, because you're incurring a greater potential for loss, right? It's sort of like if a friend of yours was going to borrow money and maybe they didn't have necessarily a great track record, you might impose different conditions simply because of the fact that they don't have a good track record. Same thing when we go to banks and banks evaluate our credit and they're looking at our past payment history and they're looking at all these variables and they're trying to make a decision. What's our likelihood to pay? And based upon that likelihood, they establish a certain level of risk, which is in turn related to their required return or the interest rate that they require you to pay as a kind of a condition of the loan, so to speak. So if you're a prime buyer, as is often referred to, and are deemed less risky, you'll have a lower interest rate because the bank isn't necessarily worried about not recouping that investment. You're more of a safe bet, so to speak. So stocks also kind of carry this element of risk versus return. So if you were to look at different types of securities, and again, this is kind of broad strokes, so nothing very, very specific in terms of what we would, in terms of like what you would see on an exact security, but if we were to say like your savings account, for example, your savings account is a pretty risk-free investment tool. And the reason for that is that, one, our financial system is very dependent upon banks operating. So even if a situation arose where a bank wasn't able to fund deposits, an FDIC, which is the Federal Deposit Insurance Corporation, or an NCUA, which is for credit unions, would step in and would help kind of make sure that those depositors could receive the funds that they put in up to a certain dollar amount, which at least today is about $250,000. So savings accounts have very, very low risk, right? As a result of that, you're not going to get a whole lot of return, right? You're going to be down kind of in this quadrant here because you're incurring virtually no risk. And that's why savings accounts pay very, very low. Most savings accounts are going to be a fraction of a percentage point. If you went to like an online savings account or a business that offered online savings, maybe they'd offer higher yield, and by higher yield, you're talking 1.5 to 2%. So still, I mean, nothing that you're going to use for really, really long-term investments, especially if you're trying to save for retirement. Now, moving on, generally speaking, you might be able to go to like Treasury Securities. And these are securities that are issued generally by the U.S. government. Now, all governments issue some kinds of bonds or generally speaking securities. But in our context, the U.S. government issues different types of securities, including bills and notes and bonds, which are simply vary based upon how quickly they have to be paid. Bonds are typically long-term. Bills are typically very short-term. So the U.S. government is believed to be kind of one of the safer investments. And so if a U.S. government bond offers let's say, I don't know what it is today, but let's say it's 1.5%, we'll call it an interest rate. It's really a coupon rate. This is considered to be a risk-free return. And the reason that we classify it as a risk-free rate or return is because the prospect of the U.S. government failing is believed to be zero. It's believed to be risk-free, zero possibility of doing that, even though technically anything is possible. But from a financial standpoint, the belief is that is a risk-free interest rate. So this becomes the benchmark to which everything else kind of fluctuates based upon, right? So that's why this is important here. So the rate of bonds is actually pretty important because other investments will look at that and kind of try to peg their returns based upon that and based upon how risky they are. So if the risk-free rate is 1.5%, then we can add certain elements to that. So then let's add in stocks to the mix, and we're just going to call these equities. Now, there's a lot of different types of equities, so I know we're covering super broad strokes. There's different corporations, different sizes and market caps, different sectors, all those different things. But ultimately, we're just, again, covering broad strokes, so hope you follow along. So equities are not risk-free. And the problem is when equities continue to increase over time, much like the housing market did during the mid-2000s, much like the past 10 years, if you've been investing in stocks, you really didn't have to be very financially astute to make money in the stock market, right? If the broader stock market increases by 30 to 40%, everybody makes money, even people that probably under normal conditions wouldn't make money, right? And so as a result of that, I think that convinces people psychologically that there isn't much risk because it's always going in value. But the reality is that equities carry quite a bit of risk, and they have in there what we would call a risk premium. And a risk premium is what we add to compensate people for risk. So again, the risk-free or the interest rate or the risk-free rate of return is 1.5%. So we might assess that equities have a risk premium of 6%. And thus the total return is about 7.5. Now, the reason I highlight this is that on average, and again, this is an average over a long period of time, equities will rise about 8% over a long period of time, 8% per year over a long period of time. Now, does that mean they rise 8% every single year? Absolutely not. Because as we've seen, it could look something like this. If we were to replace this return, and this was time, and this was the value of stocks over a period of time, it might look something like this, where it kind of goes up and down and up and down and all these different things. But ultimately, what you're seeing is kind of a trend line. You're sort of moving in a positive direction, but you've got these peaks here, and then you've got these valleys here. But over a longer period of time, you're trending in a positive direction. So this might look like the return of a stock or of a broader stock index like the S&P 500. So where this comes into play is because we know there's this risk premium, right? If something is offering a higher return, we know that it has to be riskier. It is not risk-free. If we're offering a lower return, we know that it's closer to risk-free, especially if it's a government-issued security and those sorts of things. So just by definition, stocks in themselves are actually risky. You do have to take some risk. There is a possibility that you could lose your investment, and that's a very real thing. And we've seen people that certainly has happened to. But if you look at over a long period of time, and that's where it becomes really important, is if you have what we call a longer time horizon, which means you don't need the money right away. You're not going to withdraw it. You don't need it for next month to pay your rent or your mortgage. You don't need it in the next year. If you have a longer time horizon, stocks in general can actually be really good, because even though you see this period of time, and I'm going to highlight this here, where the stock indexes contract, they decline in value. From an investor's perspective, if you have a longer time horizon, so you're not going to need the money, you're not overly concerned with that dip, because you're playing the long game. And over a longer period of time, this stock has the potential to continue to increase in value. So to answer the question, are stocks really worth it? The answer is, unfortunately, it largely depends. If you're in a position to where you're investing for a longer period of time and you're not going to touch it for a while, then stocks can be great and have been for a lot of people. If you are investing money that you maybe need to use in the short term, then stocks might not be a great investment tool, because while you might be able to catch these increases or these kind of spikes when a value increases and goes up, you might also purchase at the wrong time. And in fact, there's a lot of research that shows that people who buy and sell on their own typically don't do a very good job, because we as humans, we're very emotional, and it's really difficult to be kind of sound in our investment strategy when we see our stock declining in value. Kind of a tangent, but one of the things truly that's important when you're investing is having this longer time horizon, but also having an investment strategy is really important. And a lot of people get this confused because you don't necessarily need an investment strategy. Well, you do, but not as much when stocks are going up in value. Because if the stock market is on a tear, everybody is making money. What you usually need an investment strategy for, and where it comes into play more so, is when the stock market is deteriorating and it's collapsing. Because when we see that, again, we invest very emotionally, and it's very hard not to do that, especially when you're talking about your own money. But your investment strategy is what allows you to stay committed to the prior course of action that you set. So if you are purchasing stocks and holding them for a long period of time, you're going to see this dip here, and you're going to know, I'm holding on to the stocks because I'm investing for a 30-year period. But if you're going to use the money in the short term, you could obviously have there could be some issues there. So back to the question, are stocks really worth it? Generally speaking, yes. Even in times like this, you could argue that for some, it could represent a buying opportunity where stocks are now lower in value and you can continue to expand your portfolio. But the answer to that question depends on a lot of individual factors. And so the things that I would encourage you to think about are, one, what is your time horizon? How much time do you have? But also a fair understanding of what's your level of risk tolerance, right? Are you okay accepting a little bit more risk, seeing some of the volatility with the ups and the downs? Is that going to be something that you can withstand, knowing that if you do want a bigger return, we do have to incur a little bit more risk in order to get there?